Good evening and namaskar. Welcome to the December edition of our Wisecast, the E.M.I, which we will spend the next 1 hour speaking about our views on the economy, the stock markets, and your investment portfolio. So, at the Shuruat, let me first speak to you about the markets, right? So, the reason I want to just touch on the markets for a slide is to tell you that this year, Isal, has been a very volatile year. We began the year with all the indices in green territory, whether it's mid cap, large cap, small cap, is 1 month, 3 months, 6 months. And then in the middle of the year, suddenly we went into a bearish mode where we saw almost everything turn up to 1 year on a red zone. And then by December 15th, you see everything is almost back into a green zone. What has caused this volatility in the markets, right? So typically in the stock market, right, the returns to the investor delivered through two things which I've highlighted in green: earnings growth expectations, which is EPS growth, and rising falling demand for stocks, which is also known as valuations or P ratio, right? Now, earnings growth depends, of course, on the economic performance of the GDP, the sector in that the company is present, and then the company's performance, right? So today we'll try and talk a little bit about the economy's performance and see whether that has led to the volatility. After which we'll move on to the demand for stocks and whether there has been a variation in that and that has led to the volatility. So after understanding this is what we'll try to look at the future, both the short-term future and the long-term future, again from the lens of the economic growth and EPS growth and from the lens of falling or rising demand for stocks. So with that in perspective, let's look at the economy's performance, whether that is what has led to this volatility. If you look at the Indian economy, right, and you look at various indicators, right, we call these as high frequency indicators, tracked month on month. You see, most of the indicators, after falling in the first COVID and the second COVID wave, have generally been following a V-shaped recovery, right? Whether GST collections, two-wheeler sales, rail freight, power, passenger vehicle sales, all of them are in a recovery mode. So clearly, the economy has been on a good wicket. Similarly, the government's billing system, the e-way bills, has also been rise, which indicates heightened level of activity. You're seeing that the festive season most recently has been a very good festive season when you compare it with the previous festive seasons. You look at the automobile sector specifically, you see two-wheelers, three-wheelers, commercial vehicles, all of them have done reasonably well. And consumer sentiment index is also showing a rising trend, right? And retail sales in malls and the main streets in urban India are all showing a healthy trend, holding up compared to the pre-COVID levels, which you can see on the left of your chart versus the right of your chart. And in rural India, also wages have started rising now, which means that rural demand is also something that is likely to drive growth. From that point of view, you're seeing that already consumer spending, both from urban and rural, has reached a level of 32% as a 12-month moving average, which is much higher than the pre-COVID 30% average. So life in India, economic life has obviously got better. Specifically to the banking sector, which is the lifeblood of the economy, you're seeing the system is well capitalized, all NPAs have been well provided for, and newer NPAs, the slippages, have also come down dramatically. The impaired loans and restructured loans are also at 11-year low. And corporates have also been paying back debt to the banks ahead of time. So from 62% of GDP, corporate debt is down to about 47% of GDP. And the health of the Indian corporate system can be seen that from the CRISIL-ICRA ratio of number of companies upgraded to downgraded, today 5.5 times is the upgrade compared to downgrades, which was roughly 1.5 to 2 times in the pre-COVID period. So clearly, credit quality has improved in the Indian corporate market. And credit growth is also, after suffering during COVID, has now come in a V-shaped recovery and close to 17% of YOY growth in credit. So this especially is driven by the red line in this graph, which is the industrial credit, which is very good news for the economic activity, right? And if you look at it, the banks have been raising term deposit rates on the back of RBI rate hikes, only by about 30-35 basis points, but it indicates that they need money and they're slowly raising the rates, because on the lending side, they've actually increased it by 100 basis points. So obviously, this is good news for banks' profitability, but at the same time, it also indicates that demand for credit is allowing these rate hikes to be passed on to the consumer. So you see, scheduled commercial banks, especially private sector banks, have seen a strong widening of their margins, while even public sector banks have seen some widening of their net interest margins, right? And what is also driving retail credit is the housing loan sector. And as you can see, new residential launches in the top 7 cities continues to show a V-shaped rise. And especially Delhi, for example, we've seen that property registration during the festive season have shown a 20-25% jump, right? And while this is a chart of the pollution on a month-end basis, we've compared this month-end, November month-end to last year's November. You can see a greater degree of pollution is prevalent across all the top cities of India, which means while it's not good news for air quality, it's good news from the fact that activity levels are back to normal. That's what this slide is trying to convey, right? And if you look at the GDP numbers themselves, our GDP quarter 2 has been about 6.3%, very healthy, driven by private financial consumption and gross fixed capital formation, right? And from a sectoral growth perspective, it's the services sector with a 9% and agree with 4.5%, which have driven the growth of the economy. So overall, if you look at a PMI, which tries to give a prediction of the GDP for the next few months, both services and manufacturing PMI trending above 50 and on a rising trend, which means that in the coming quarters, GDP numbers should continue to remain healthy, which is what the activity tracker index computed by Morgan Stanley is also reiterating for us. And corporate profits, which is the EPS part, you can see have kept pace. If you see on a logarithmic scale, it is keeping pace. And if you actually divide profits by GDP, you're saying that corporate profits to GDP ratio is in a V-shaped recovery, which means profits are rising faster than country's GDP, which is good news from a stock market perspective. So naturally, if TEPS is on a rising trend, and we expect to do about 21% CAGR over the 20 to 24 period. So clearly, the domestic economy numbers and the corporate profitability numbers are fairly robust, but still you have extreme volatility. So clearly, economy is not the reason for the volatility. The volatility then is coming from a rising, falling demand for stocks. So now to look at that, there are two sets of sources of primary demand. There's the foreign investors, and then there are domestic investors. This table in the left-hand pie chart tells you the current ownership of the Indian stock market. So as you can see, 45.1% of the Indian stock market is owned by private promoters, which is the owners of the companies. And the rest is spread among various investors. Now, if you take away the 45%, because that is never available for sale, right? Promoters don't like to get rid of their own holdings, right? So from that point of view, in the table on the right-hand side, I have taken the net 54%, which is available for sale, which is also commonly called as the free float market cap. And you see the proportion of ownership of the free float market cap. You can see that FIIs tend to dominate it with currently a 37% share of the free float. So clearly demand from foreign investors. And then if you come to domestic mutual funds, so they are also a healthy 14% of the free float. So put together, these two account for half of the Indian free float market cap. Hence, whatever they do is what is driving the volatility in the market. The rest of the players, retail, HNI, insurers, LIC, are all spread out over thousands of people, and hence they can't be a collective action which explains volatility. There it's more of a sentimental and a view-based approach. So we will now focus on these two big players, that is the FIIs and the domestic mutual funds, to understand the volatility in the market. So if you now look at the flows on a quarter-by-quarter basis post-COVID, right? You can see the top line tells you about FII. The green means inflow, the red means outflow. So there's been long periods of inflows, then a short period of outflows, and again inflows. Whereas investment activity from mutual funds, which is dependent on investors giving them money, is started off in the COVID phase by heavy withdrawals, hence mutual funds sold, then came to a phase where they started buying, and that has continued now with an SIP book also touching 13,000 crores. So if you see the net flows in the market, by and large, the market has received positive flows, except for those 2 quarters in the beginning of this year. So as you can see, that's the period we saw volatility. Now we'll try to dig deep, because that volatility, as you can see, has been caused by the FIIs pulling out a huge amount of money. Why did they do that? Right? So understanding the recent FII flow patterns. Now, this FII pie, if you break it up, right, that 37% of the holding of free float, of that you see 68% are mutual funds and hedge funds. And these are generally hot money because they're very active managers, both hedge funds and mutual funds, other than ETFs. And even ETFs, the customers give them money, they buy the index. So these are the ones in the first line, if you see what we can call as the hot money, which although it accounts for 2/3 of the FII holdings, accounted for 3/4 of the outflow. So clearly it's their action which has driven this. The other long-term money we'll come to later, but that has been a constant and we will address this in the second part of our presentation. Now, to understand these hot flows money, so FIIs need to have availability of money, which is liquidity, and they need to have low interest rates so that they can borrow cheap and invest in the market of their choice. So the first condition for an FII broad inflow into emerging markets into India is the availability of low interest rates and a lot of liquidity. And then depending on the emerging markets attractiveness, emerging markets get money, and India's share depends on how we will get the attractiveness related to emerging markets for the Indian industry. So let's look at the interest rate and liquidity scenario starting with COVID. Right now, when you see that the inflation scenario is very critical to understand at this point in time, because inflation is nothing but demand minus supply. Why do we focus on inflation? Because the inflation which drives the interest rates in the economy from the central bankers. So if you see here, inflation can be caused by either an increase in demand or a shortage of supply, or both can happen. So what happened during COVID? During COVID, you saw that demand collapsed initially. So demand collapse brought down the prices of input prices, such as natural gas, Brent, coal on the energy side, and food and metal on the other commodity side. So I've circled the point to show you how sharp a drop in prices you saw there, right? Almost a 40% correction in energy prices and a 20% correction in overall commodity prices. So obviously, this happened because due to lockdowns, demand was constrained during COVID, hence commodity prices falling, and hence we had a deflationary scenario instead of inflation in the beginning in 2020. So from a hot money, the mutual fund, hedge fund, Basel, when they look at it, for them, for India, the oil price fall is very positive as an entry because India imports 83% of its oil. Hence, I've listed out the 8 reasons why FIS tend to allocate more money to India during a time when commodity and oil prices fall. I will leave the slide on for 5 seconds for you to read these 8 points. They will keep coming again and again. So not to worry if you're not been able to completely see it. But now you can see how what I said is actually happened. In this period of COVID, when the oil prices fell down, you can see almost every emerging market saw a pullout by FIIs, but India, starting from April, May, June of 2020, when the lockdown started, has seen a very strong positive inflow shown in green compared to all the emerging markets. So the point that I made that because we import 83%, oil's price expectation is a key element in deciding FII allocations to India. Right now, we move back to the global economy when just after 2020, in 2021, situation turned opposite and became inflationary from deflationary. Why does this happen? Again, the inflation, right? Demand minus supply. So this time what happened, there was a manufacturing shortage. Because of the manufacturing shortage due to lockdown, items like semiconductors all were severe shortage, and you saw inflation rise because of the supply side push. And on the demand side, the government started responding to the COVID deflation by cutting rates, by creating liquidity through quantitative easing, and by giving money to the taxpayers through fiscal stimulus. All of this to avoid the economy. So naturally, demand also started rising. So you had supply falling, demand rising. Hence, a deflationary situation caused transferred to an inflationary situation. So how's the extent of the rate cut they did? The US, which was at about 2.5%, short-term interest rates brought it down to 0.5%. And the ECB, which was already at 0.5%, brought it down to negative 0.5%. So these strong cuts combined with the pumping of liquidity, as you can see on the left-hand side, the US has seen something like a doubling of the liquidity available from 4.5 trillion to 9 trillion. At the same time, the G4 countries, which account for 90% plus of FII flows outside of advanced countries, the G4 being the US, the UK, Europe, and Japan, also doubled the liquidity that was there in on tap from about $14 trillion to $28 trillion. From that point of view, the reason that this impacted inflation is because in the US inflation, which I've just given the table there, you can see that 42% of US inflation comes from the housing sector. So naturally, a rate cut leading to a demand for housing would perk up the inflation, which is exactly what happened. Those rate cuts allowed US consumers to borrow 30-year fixed mortgage loans at 2.75% per annum. So naturally, there was a huge housing boom, which led to inflation. And so what we saw was from 1.5%, the first batch of the inflation went all the way up to 5.5%. Right? So you saw that due to COVID supply chain disruption, and then you had the US fiscal stimulus of $3,600 for every taxpayer, plus these rate cuts and the quantitative easing. Right? Now comes the second layer of inflation that happened from October onwards. What happened? The Russia-Ukraine crisis started looming. Energy prices started going up because Russia is a key supplier of energy. There's an apprehension that crude supplies would come down sharply. Ukraine is a big supplier of food and soya and wheat, and their prices also started going up because of shortage expected. So now you see what happened is that the same commodity prices that fell 20% now were up hugely. At the same time, the right energy prices, which fell 40%, were up 200%. The combined effect of these two led to the inflation spiking on the left-hand side from its 5.5% level all the way up to 8.5%. And now the same slide comes back again. When oil prices started rising from $60 to $125, all these negatives come and impact FII's thought process about India. And naturally, you saw that same India, which was receiving money during the COVID deflation, now started seeing a massive outflow due to the inflationary role. So can you see the oil price increase is seen there in the 3 consecutive quarters, October, November, December, January, February, March, April, May, June, they pulled out heavily from the Indian market, right? So now what happened in June? In the global economy, they were wrestling with this battle between inflation and growth. Now clearly inflation became priority. Why? Because from a 1.5%, inflation went all the way to 9%. They had 6 times the inflation which they had pre-COVID. So because of that, the strong rate action, and they want, the dotted line tells you where they want to bring it down to about 3% by the end of next year. So a series of massive rate hikes. Why rate hikes again? Because they want to cool down the demand. So the inflation equation again is in front of you. The increase in demand, they want to now make a decrease in demand. So hyperinflation targeting to cool the demand through interest rate hikes. How much? From a 0.5% level that was there in June 28, they now brought the rates up to 4% on the shorter end of the curve, and the ECB went from minus to 2.25% plus. These huge rate hikes naturally have seen that in this period, 2022 has seen the fastest pace of rate hikes in the history. I've shown the previous times, 2009, 2020, each year, no time in history has there been such a sharp hike in rates as has been experienced now. So naturally, even the government's borrowing rate in the US, the short-term rates went to 4%, the government's long-term borrowings rate went to 3.5%, come from a less than 1%. So the cost of the government also went up in the US. So naturally, housing loans, which were earlier at 2.75, today are available at 6%. So you're naturally seeing a drop in the new home demand, and home prices have started falling on a weighted average for the US. The IMF is telling us, according to their projections, while world growth is going to halve this year from last year, and next year will taper down to 2.7, in the advanced countries, it's not only going to halve from last year, it's going to halve next year from 5.2 down to 1.1, whereas emerging economies are in a relatively better position. So what has happened is that now the probability of recession, the World Bank's are still showing a 1.1% positive growth for advanced countries, but a recession means negative growth. And you see that the probability of that coming over the next 12 months, when Fed did a survey of professional forecasters, is at a historic high. It's the most anticipated recession ever. Right. So from that point of view, across a range of advanced countries, the probability of recession is ruling at anywhere between 50 to 75%. And this is also supported by the fact that while short-term rates are going up, you're seeing that the long-term rates for the US over the last 1 month have come down by 32 basis points. This is called an inverted yield curve, where short-term rates are rising, but long-term rates are falling down. This inverted yield curve, if you see over the past 7 recessions, whenever inverted yield curve has happened, a recession has followed. So this is another reinforcement on the expected recession in the advanced countries. And this is being reflected in the green line, which is the dollar index, which was continuously rising because when the US government's rate of borrowing was going up, a lot of money was chasing the US. And so the demand for the dollar went up, the dollar index was appreciating. Today, you're seeing that with a 32 basis points correction, money is started flowing out of US, and there's a dollar starting to weaken. Again, an indicator of a recession. The third is the behavior of gold. Gold is a safe haven alternative to the dollar. And so when the dollar was strengthening, the gold was weakening. So 6 months gold is down 3%, but 3 months gold is up 6%, because in that period is when the rate hikes have come in. And as dollar weakens, you're seeing gold is strengthening, right? Another indicator of recession. So now, naturally, with the expected recession, a deflation in commodity prices has again started. So you are seeing that the same metal, food, and Brent, which went up sharply from June onwards, have started coming down sharply. So you're back to what we saw during COVID. Further, the supply constraints that came because of COVID, not because COVID has by and large been tackled in the world, barring in China, you're seeing that the supply chain impact is also coming down on inflation. So because of that, now we are back to the situation where an oil price has started falling from $125 to $80. And again, the positives of the Indian economy are coming to the fore. And hence, you're seeing again that from July, August, September, for the first quarter, we got $6 billion. And in the 2.5 months of the next quarter, we've got $5.5 billion. So again, the FI behavior is reflecting the outlook for oil in terms of their investment in India. To summarize the whole situation, I've shown the timelines on the left and the situation of commodity deflation, commodity inflation, and followed by again a commodity deflation, which is what has led to these flows as a pattern. And as you can see, during deflation, there was $38 billion of inflows. During the inflation, there was $33 billion of outflows. And now during the deflation in this period, you've already seen 11 billion of the 33 billion, 1/3 has already come in. So now when we look at the other player, MF chart, if you can see, it's clearly reflecting the domestic economic outlook. During the pandemic, they felt that the Indian economy is going to suffer. So mutual fund investors pulled out money from mutual funds, and mutual funds were forced to sell. So something like 1.13 lakh crores they sold. But subsequently, from the April, May, June of 2021 itself, investors are seeing a V-shaped economic recovery, and they are consistently started giving money to mutual funds. So almost 3 lakh crores of money has come into the market to buy from a mutual fund investor's perspective. So that's the behavior is clearly linked to the domestic economic outlook. Right now, to summarize the whole thing. So now when you see this, you can clearly see that the October, November, December quarter, when FIS started selling India, mutual funds were actually continuing to buy India because their outlook was good. So the first quarter of October, November, December, you saw that still net positive buying of 7,430 crores took place. But from the next quarter, the FIS selling was so strong that 2 consecutive quarters, we had almost 35 to 40,000 crores of net selling in the market, and hence there was a correction, and then there's a buying and a bounce back. So that's what is reflected. The same chart that I showed at the beginning, I have now added the commentary on the right side of why that happened. So the bullish tone as of January was because though FIS selling started due to commodity inflation from October, strong domestic mutual fund buying offset that and the markets were positive. The next phase, the commodity inflation phase continuing, heavy FIS selling only partially offset by domestic mutual fund buying, hence everything turned red. Now you're seeing a situation in a deflation where not only are FIS buying, but now domestic mutual funds are also net buyers. The double barrel buying has caused a bounce back in the market. Right. So from a short-term equity outlook, then if you then look at it, it entirely depends on the flows because the economy's performance you've already seen. So again, to reiterate that whole situation, that emerging markets attractiveness is what will attract money, and you are seeing that emerging economies have already expected to perform better. So that's why you expect the flows to emerging market continue strong, because next year, against a 1.1% growth on the advanced economies, there's going to be a 3.7% expected growth on the emerging economies. Right. So from that point of view, let's look at the attractiveness of the Indian economy. And here, if you see, India's growth story is clearly decoupled from the rest of the world. Why? The same 3.7% next year expected emerging market growth is actually driven by a 6.1% growth by India, another 4.4% by China. So clearly, India is going to be the fastest growing country in the world next year. And hence, if you see the revisions of growth forecasts, India's has been rising or stable, whereas all other countries have been revised downwards, because of which you can see that in a manufacturing PMI and the services PMI in the next slide, that India is by far the fastest growing in terms of expected PMI growth, whether it's manufacturing or it's services. And while India will be affected by recession, the relative impact of the recession in India is going to be relatively very, very less. So from that point of view, the other reason why India's impact is going to be less is though our exports have grown strongly over the last 1.5 decades, the fact is that we only account for 1.9% of the world exports. Hence, from that point of view, if you look at it, 98% of the impact of a slowdown stroke recession in the world will be felt on other countries, and only 2% of the impact will be felt on India. So you can expect our growth rate of 6.1 to get corrected to some extent, but maybe to say a 5.5, but still the rest of the world will be close to zero, and India will be a shining star in the world. Hence, the probability of a recession in India is fairly negligible. So now when you look at it, you also have to look at it from an FI perspective at the fiscal situation of the government, because the risk of the country depends on this. So from that point of view, if you see India today, just by size of GDP, is the 5th largest country in the world. So in the top 12 countries by size of GDP, India being 5th, however, in the next column there, if you see, I have circled it, India's debt, external debt, is the lowest in the world among the top 12 nations. Right? So our borrowing from the rest of the world is very, very less. And as a percentage of GDP, if you compute it, we are the second best country in the world, just behind China. China is the best because their GDP is large. Their borrowing, though is large, is still compensated by the size of GDP. India has a much smaller GDP, but a much smaller borrowing. Hence, we are at only 17.6% external debt to GDP. So clearly, our fiscal situation is fairly promising. And the second thing is for the first 6 months of the current year, you see the budget forecast a 13.6% growth in corporate tax and a 13.4% growth in income tax, roughly about 13.5% each, but actual results turned out to be 22 and 26. GST was projected to grow at 15.6%, actual turned out to be 33%. So clearly, income for the government has been far better than projected. Not only indicates that the economy is also chugging on well, it means the government's fiscal situation also is reasonably comfortable. In fact, in the first 6 months, the government has spent only 37% of its annual fiscal deficit target. Normally, they spent 70 to 80%, even 90% on the first 6 months. And so this time, it's not been the case. Now, within that, we spoke so much about world inflation. What is the Indian situation of inflation? The first thing is that Indian inflation is very differently driven than the American inflation. America's inflation is 42% driven by housing. India's is 48% driven by food. So this is a supply side inflation. America's is a demand side inflation. That's the number one. Number two is though those inflation levels in June appeared to be near each other, with India at say 7.5 and US at 8.5. The fact is that we have always been at a 5, 6, 7% inflation and are trending around that a little bit higher. But the US has gone for 6 times hike. So same number is the same, close to each other, doesn't mean the situation is the same. It's a usual situation for us, very unusual situation for the US, right? And if you see, because food is the main component and because monsoon is the key contributor to food inflation, we've had a good monsoon for the Kharif crop and the reservoirs are full for the Rabi crop for next year. RBI is expecting by next year, first quarter, we should be down below 5% on the projected inflation. So obviously our inflation trajectory is coming down on its own without intervention by RBI to be necessarily very strong. So we don't have to kill demand to achieve a reduction in inflation, right? And also the fact that the wholesale price index, which is where a lot of the imported inflation tends to sit, is also showing a declining trend. So because of which food prices are trending down. And now when we come to the currency, because for an FII, any negative movement in the currency beyond anticipation could lead to losses, whereas a positive move could lead to gains. So they predict currency very, very, accurately or trying to be accurate at least. And hence a lot of the decision making is based on expected currency movement. And India has done a very good job because our currency, though it is weakened, has only weakened as much as the dollar has strengthened. So from that point of view, whatever an FI expected with the interest rate differential between the two countries is what has actually happened in terms of rupee depreciation. So it's not been a negative surprise to them. Why this happened? Because India chose to buy cheaper oil from Russia, which saved us money. Both our inflation came down and helped our currency because we paid them in rubles or in barter trade and not in dollars. The second is that India's FDI flows have been healthy. India's external commercial borrowings bringing in dollars has been steady. India's NRIs have given us money. The red line, you can see it going up. So all of this has helped our forex reserves go up to $640 billion. RBI used $100 billion in their fight to defend the rupee, which is how they achieved that parity with the dollar's appreciation. Now, if you see, the dollar's reserves have gone up by last 2 weeks by $30 billion. So clearly, from a currency perspective, India is not in a worrisome situation. In fact, in the coming days, the weakness of the dollar will be beneficial for and positive for the Indian rupee. So currency-wise also there's no concern. And today the interest rate differential between the US and India is close to 4%. And if you see over the last 3 months, the depreciation has been 4%, and maybe over 6 months has been 6%. So you can see that there's a chance for the rupee to appreciate, to bring down the overall level of depreciation down to the difference in the interest rates. The 3-year number is a simple number. So if you look at the compounding, it probably comes to about say 4.5 to 5% compounded, coming to 16.55. So the coming months could see actually a strengthening of the rupee to bring down the 3-year depreciation also down to the level of the interest rate differential. So the currency also there is no worry. And in fact, RBI, even the recent rate hike, is probably done more with the currency in mind rather than with inflation in mind. And so as the US is expected to do a couple of more rate hikes, you will see RBI also do that more from a defending the currency perspective than from a controlling the inflation perspective. So as a result of this, India's outlook being much better, the hot fires got their calculations totally wrong. Because all the negatives they thought when the oil price went up sharply, which are marked in red, did not happen the way they anticipated. You've already seen that inflation was not alarming, RBI didn't do massive rate hikes, demand didn't get affected, trade deficit, everything. Only corporate margins, which are marked in green, was the only one the FIS got it right. All the rest, they got it wrong. As a result of which, year to date, if you see, yes, market cap has got eroded for their investments across the world, but the least erosion has happened from India at -2, where they lost somewhere between 17 to 25% of their capital in all the other investments. And hence, if you see, we talked about long-term FIIs who did not pull out money in this period. Those people obviously have been rewarded because when you look at it from a post-COVID, the yellow line is India. If you take the post-COVID, the COVID level at 60 for the MSCI index, we are now at 140. So we are the country which has delivered the best returns to the longer term FII post-COVID. If you take it back to last 3 years also, if you see the MSCI index has delivered a 56% 3-year return, whereas none of the countries are anywhere close to us. And even on a 1-year basis, we are probably, us and Singapore are the only two markets to be positive in terms of a 1-year return as of yesterday. So clearly the FIIs, by pulling out money, the hot money, have burnt their fingers because they got their calculations wrong. And not only that, if you see over a longer term, right from 2002 onwards, Indian markets returns have been better than the world markets returns. So if we rebase both to 1993, you can clearly see the blue of India has outperformed the orange of the AC world, which is all country world index handsomely. So the longer term FII has been amply rewarded for its faith in India, right? Not only has the point-to-point returns been better, but the relative volatility of the Indian market has been much better than the volatility of the global markets. So the journey to that better return has also been far smoother for an FII investing in India. Naturally, this is because of the strong support from domestic flows, which have bought every time that the FIIs have been selling, thereby dampening the fall of the market, right? So the reason for this is that the Indian investor, whether it's a foreign investor investing in India or an Indian investor investing in a stock market, from early 2000s when they were actually staying somewhere between 15 to 20 months in terms of their staying time in the market, today they have doubled or even tripled that to somewhere between 35 to 40 months. So the longer they stay, the less selling, panic selling or thing happens. So that also gives a stability, and that's why Indian market volatility has been much, much lesser. So coming to a valuations perspective, from a relative perspective, valuations, remember one thing, that India, right from 2012, as this table shows, has been consistently receiving FII money compared to any other emerging market, number one. Number two, this 37% ownership of the Indian market now has been the same level pretty much from 2006, which means FIIs have been continuously owning somewhere between 35 to 45% of the free float market cap of our country for the last 16 years. So that previous slide, and this tells you that the long-term FIIs have stayed invested in India, and even the passive money which you get from an ETF, right? India's weight has gone up from 6.7% of the index to 15%, more than 2.5 times India's weightage is gone. So naturally, passive funds have been forced to allocate that much more to India over the last decade. From that point of view, yes, India's P ratio has been rising and our premium relative to emerging market has been rising. In fact, our premium relative to the world market is also rising. What this is telling you is that in their diversified portfolio for an FII, India is a growth stock which justifies the high valuation and hence justifies the premium. So yes, India is expensive compared to the world, expensive compared to the emerging market, but that has not been a cause of worry because right from 2006, we have been at a premium and FIIs have continued to invest in our market despite being at a premium. So the level of the premium only reflects the relative hot money coming in or going out, but as a consistent level of FII support is there because India's growth is getting its value. So the PE ratio is being viewed as a PE growth ratio, which is the PEG or the PEG ratio as it's called. So hence, individually also within each emerging market country, we have overall emerging market average, we are premium, but we are at a premium to Brazil, South Korea, China, Taiwan, to every market, right? So that's where the quality of the Indian growth story is important. And hence now, if you look at the valuations from our own history, compare it to our own past, you will see that the red line, which gives you the long-term average of the Indian Nifty's P ratio, is around the 19.5 mark, and today's 1 year forward PE is also exactly around the 19.5 mark. So compared to our historic valuations, today's market level is not expensive, nor is it cheap, nor is it expensive. It is rightly valued. And a few months ago in October, when the market was at its peak, was when the market was showing at a 23 PE ratio. And in December 2017, it was at a 25 PE ratio almost. So we are far removed from those kind of valuation levels compared to our own history. So from a short-term perspective, clearly the outlook for the market will be driven from a flows perspective. So what are we talking about here? All we are saying is that Indian economics growth story hasn't undergone a change. Oil prices rose and fell and rose and fell, right? So if you see now the pattern, The first row tells you that the period, right? So you have the first bit between April 2020 to September 21, the COVID period. Then you have the October 21 to June, which is the Russian crisis period. And then you have the July to now date, right? You all know that we went through a period of deflation, inflation, deflation. And that's why there's inflow, outflow, inflow. The first line gives it to you in dollars. The next line gives you to in rupees crores. So focusing on the crores there, so you had 2.8 lakh crores of money being invested in India during the COVID period. You had 2.6 lakh crore, 2.55 lakh crore of that pulled out during the Russia-Ukraine crisis related oil price increase. Of that, today 93,000 crores, which is 11.7 billion, has come back. So there's still 1,62,000 crores of FII money waiting to come to India when they get a clarity on the direction of oil prices and commodity deflation. Domestic mutual funds, on the contrary, during COVID pulled out 55,000 crores. Then they brought in 1.9 lakh crores in the times that the FIS sold 2.5 lakh crores. That's why the fall in the Indian market was less than the fall in other world markets during this period. Number one. Number two is that despite that, there was a net selling. So net, you had still had a 66,000 net selling in the market. So the market since of June came down. Now, post that, in addition to the 94,000 crores of FII flows, we have had 34,000 crores of domestic mutual fund inflows. So total of 1.27 lakh crores of buying has come into the Indian market. And that buying in the Indian market means that today 1,62,000 crores of money is waiting to come into the Indian market, plus whatever domestic mutual fund investors give to the market. So we are seeing that there is a strong buying flow waiting to happen. So what is the timing of this flow that can happen and trigger? So first of all, if you see, there is going to be a flow into emerging markets. So there is a Bloomberg which calculates a proxy for emerging market capital flows. That is telling you that the index went below its historic average and has started coming back, but is still not back at its average. So there is still money waiting to come into emerging markets based on the comparison with historical average. That's number one. Number two is that the active fund managers who account for most of the flows, right? Despite their recent coming back, they have been historically having India as overweight in the portfolio, but they moved underweight starting from October last year. And while that underweight situation has improved, it is still not back to overweight. So in the coming quarters, you will see that with the oil prices and Indian growth story being strong, you will see this underweight position go back into an overweight position, which means allocating of more money to India compared to other emerging countries. The third aspect here is that the rate hikes are going to cause the oil price to come down because demand will come down, are still not done. Why? Because even now, the US wage growth has not fallen in any appreciable way. You can see a small tick down, but wage growth is still at 6.7%. So the wage growth means some more rate hikes to kill demand are due. And when that happens is when you will see the next fall in the oil. And that's why if you see, while housing has corrected in price inflation in a lot of cities at the bottom of the table, on the top hand, you can see in some places it's still in high double digits in terms of the rise in prices on a YOY basis. So there is still way to go in terms of cooling down the housing demand in the US. The third thing is, while we have seen commodity prices drop from the deflation for India perspective, if you index it to pre-COVID, right, all these prices are still above their pre-COVID levels. So there is still way to go with further rate hikes and killing demand and a recession coming for the overall prices of oil, food, and metals to come down. But specifically for India, oil is important. And from an oil perspective, if you look at it, there is a big player called OPEC, which, if you see this table, tells you that the world's demand for oil is about 100 million barrels per day. In the middle, you can see the fourth quarter 21 number. It's about 100 million barrels per day. Of that, 70 million barrels is supplied by non-OPEC supply. So 70% of the world's oil requirement are supplied by non-OPEC people. The balance 30 million barrels, OPEC controls the supply and only supplied 27 million barrels to keep the price high. As I told you, inflation is about supply cutting or demand dropping. So oil prices are not falling below a certain level. The other reason why OPEC is able to hold it is because it's winter now in America and Europe. So heating requirements need oil, furnace oil. So those are keeping oil demand high and not allowing it to fall very, very, very much. So OPEC is also able to then cut supply and keep them on the edge. Third is US has announced a price cap which the European countries are falling in line on Russian oil at $60. Now that will help India to buy that oil cheaper, but the fact is that the European countries, if they're not going to buy oil from Russia, because Russia clearly said, I will not supply to anybody who signs up for the price cap, they are forced to buy oil from the OPEC countries like Saudi Arabia, and hence they will be able to keep the prices high. So when will this then change? If you go back now and look at the first column in this table to 2020, you saw that the demand had dropped to 91 million barrels. So from 100 to 91 is roughly about 9 to 10% drop. When that happens, OPEC was not able to drop its supply, cut its supply below 25 million barrels. So there is a core beyond which they can't cut supply to keep the price high. That's when oil price crashed. So a 10% shift in demand. When can this happen? It can happen when the winter gets over, and then as spring and summer set in, the demand for heating comes down sharply. At the same time, the rate hikes will help cool the demand itself for oil. So in starting from March, April onwards, I expect that the world oil demand will come down. And as that comes down, OPEC's hand will be weakened and you will see oil perhaps drop lower. So this then will be the trigger for the FIS, the balance 1.6 lakh crore, to take the next call on India from an active fund manager like a hedge fund or a mutual fund to allocate more to India and make it more underweight to overweight. Right? So that's what is shown here. The oil price has come down to the level of just below 80, but our average price pre-COVID was around the $60. So that's when you will see the FI's outlook taking the next leap forward on India. Right? And just to summarize now, the global markets where they are headed, the Bank of America has got an indicator called the bull and bear indicator using 6 or 7 factors. They say that this indicator, which comes out with a number between 0 and 10, if it's 8 and above, it's a very bull market, which means due correction. It's 2 and below, it's extreme bear market due for a bounce back. So today the market's level is at 2. So it's not an extreme buy zone, but it's very far from a sell zone. So overall world equity markets are also rightly positioned for more money to flow into equities as the liquidity tap will continue to remain during the recession times. So interest rates will also expected by December to stabilize and then start dropping as they now try to boost growth. So the equity markets are set for a fresh inflow, liquidity and low interest rate driven flow into risk assets like equities, right? So from that point of view, right, I would like to call it a halt on the outlook on the markets. I have focused more on the shorter term. I've looked at the history to give you a sense of what to expect over the next 15, 12 months. I'd like to close the session for today. Thank you for participating. We shall delve a little more into the future aspects of it in the next month's E.M.I, which will also be just ahead of the budget, and we'll have some things around what you can expect from the budget at this stage. So thank you very, very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.